Understanding return on assets, ROA. Return on assets, ROA, is a critical financial metric that provides insight into a company's profitability in relation to its total assets. By measuring how efficiently a company utilizes its assets to generate earnings, ROA serves as a vital tool for corporate management, analysts, and investors to gauge operational effectiveness. Key takeaways. Definition: ROA is a ratio that indicates a company's profitability relative to its total assets. Efficiency measurement: it allows for measurement of asset efficiency, which is essential for understanding a company's financial health. Calculation: ROA is calculated by dividing net income by total assets. Industry comparison: ROA is best analyzed within the context of the same industry to ensure comparability. Debt inclusion: unlike return on equity, ROE, ROA incorporates a company's debt, presenting a more comprehensive evaluation of asset use. What is return on assets, ROA? ROA is commonly expressed as a percentage and reflects how well a company converts its investments into earnings. In essence, a higher ROA indicates a company is more effective in managing its assets to produce profit, while a lower ROA could suggest that there are areas for operational improvement. Businesses thrive on efficiency, thus, comparing profits to the resources utilized to generate those profits gives investors a clearer picture of a company's viability. ROA serves as a straightforward indicator of how well a company invests its capital or assets to achieve financial returns. ROA calculation. The formula to calculate ROA is as follows. Backslash text, return on assets, ROA, equals \frac, text, net income, text, total assets. Example calculation. Consider two hypothetical hot dog stands run by Sam and Milan. Sam invests $1,500 and generates a net income of $150. Milan invests $15,000 and generates a net income of $1,200. Calculating ROA for both. Sam's ROA. \frac 150, 1500 equals 0.10 text, or 10%. Milan's ROA. \frac 1200, 15,000 equals 0.08 text, or 8%. Here, Sam shows a higher ROA, indicating he is using his assets more efficiently than Milan, despite Milan having a larger net income. Special considerations. Interpreting ROA. A critical consideration when evaluating ROA is to remember that total assets often include both liabilities and equity. Debts incurred to acquire these assets affect net income and should be considered in the analysis. Some analysts adjust the ROA calculation by adding back interest expenses to net income to better reflect true operational performance. ROA versus ROE. While both ROA and ROE measure resource utilization, they differ significantly in their treatment of company debt. ROA considers overall asset efficiency and the impact of debt, whereas ROE evaluates only returns on equity, ignoring liabilities. This distinction is important, as an increase in debt can elevate ROE while potentially lowering ROA, highlighting variations in financial health. Limitations of ROA. Despite its usefulness, ROA has limitations. Industry differences. Comparing ROA across different industries can be misleading due to varying asset bases. For instance, service-oriented sectors such as finance often exhibit higher ROAs than capital-intensive industries like manufacturing or utilities. Historical cost versus market value. The basic ROA calculation may not adequately represent true asset value. Non-financial companies typically account for assets at their historical cost rather than market value, which can misrepresent financial efficiency. Alternative ROA calculations. To address the inconsistencies in the traditional ROA formula, two variations have been proposed. 1. Variation 1. ROA equals frac text, net income, plus, text, interest expense, times, 1, text, tax rate, text, total assets. 2. Variation 2. ROA equals frac, text, operating income, times, 1, text, tax rate, text, total assets. These formulas help adjust the calculations to give a more comprehensive view of a company's operational efficiency, inviting more accurate comparisons. ROA in practice. ROA serves as a benchmark for assessing financial performance. For example, let's hypothetically examine 3 retail companies to illustrate normalized ROA, which excludes non-recurring expenses, for the trailing 12 months. Company net income total assets normalized ROA. A. $800,000 $10 million 8%. B. $600,000 $5 million 12%. C. $1 million $15 million 6.67%. In this scenario, Company B displays the highest normalized ROA, indicating superior asset efficiency compared to its peers. Conclusion. Return on assets is a vital financial metric that provides insight into how well a company utilizes its resources to generate profit. While it plays a crucial role in financial analysis, investors and analysts should utilize it alongside other financial metrics to gain a comprehensive understanding of a company's operational success. Further, recognizing the limitations of ROA, particularly when analyzing firms from different industries, remains essential to making informed investment decisions.